Sydney's auction clearance rate just hit 51%. A year ago, on the exact same weekend, it was 75.7%. That means right now, almost half of every home taken to auction in Sydney is walking away unsold. And it's not because buyers disappeared, it's because investors did. Something shifted in this market in the last 6 weeks, and it wasn't subtle. Let's break down what actually happened. For the past few years, Sydney property investors had a playbook: buy an established house, negative gear it, ride the capital growth, and use the 50% capital gains discount when you sell. That playbook just got rewritten. On the night of May 12, 2026, at 7:30 p.m, the federal government handed down its budget. Buried inside it were the biggest changes to property tax rules in almost 30 years. According to the Treasury's own budget papers, negative gearing on established residential property is being phased out. Anyone who buys an existing house or unit after that exact date and time will no longer be able to use rental losses to reduce their tax on salary or wages. The losses still exist, but from July 2027, they can only be offset against rental income or against a future capital gain on that property. On top of that, the 50% capital gains discount is being replaced with a system based on inflation, plus a new 30% minimum tax on gains made after July 2027. The Treasurer's Office frames this as a way to level the playing field for first home buyers. Property investors and several tax advisory firms, including William Buck and Baker McKenzie, have publicly broken down the changes and flagged that the financial maths for buying established property just got noticeably worse. Both sides agree on one thing: this is the line in the sand. Buy before 7:30 p.m. on May 12 and you're grandfathered under the old rules. Buy after it and you're playing a different game entirely. And there's a second part to this that doesn't get nearly as much attention. The same budget is making it easier for owner-occupiers to get into the market. The federal First Home Buyer Guarantee Scheme now lets eligible buyers purchase with just a 5% deposit backed by the government. And in New South Wales, that covers properties valued up to $1.5 million. That's not just cheap outer suburban stock, that's median-priced Sydney homes. So, in the space of one budget announcement, the government made it harder for investors to buy established property and easier for first home buyers to compete for the exact same stock. That combination is doing a lot of the heavy lifting in this story.
Here's what that looks like in real numbers. In the same week the budget changes were confirmed, Sydney's auction clearance rate dropped to a year-to-date low. Domain and CoreLogic-style weekly tracking both show Sydney sitting around 51 to 58% through May and June 2026, compared to results in the mid-70s this time last year. Coretality's Home Value Index recorded Sydney dwelling values falling 0.9% in May alone, with prices now sitting below where they were back in October 2025. Tim Lawless, research director at Coretality, pointed out that falling clearance rates are now coinciding with a pickup in advertised supply, which gives buyers more choice and a lot less urgency at the negotiating table. That's the key word right now: urgency. It's gone. New listings are actually down 10.4% year-on-year, which under normal conditions would prop prices up, but total stock isn't shrinking because homes are sitting on the market longer. Vendors are discounting by around 3% off their asking price just to get deals done. Meanwhile, the Reserve Bank hasn't made life easier. The cash rate moved to 3.85% in February 2026, then to 4.10% in March, with ANZ flagging the possibility of a further move toward 4.35%. Each quarter-point hike strips roughly $12,000 off the average buyer's borrowing capacity. 2 hikes back-to-back means around $24,000 less purchasing power, landing in a market where the median Sydney house is sitting above $1.6 million. At auction specifically, the median Sydney house price recently came in at $1.8 million, down 8.9% from $1.975 million at the same point last year. But Sydney's auction market isn't moving as one block either, and this is where it gets interesting. In the most recent weekend of results, the northern beaches recorded the strongest regional clearance rate in the city at 75%, while the central coast came in at just 25%. Houses cleared at 53.6% and units at 65.7% over the same week. The top sale reported was a four-bedroom house in Willoughby that sold for $6.67 million, while the most affordable result was a one-bedroom unit in Homebush West that went for $402,500. That spread tells you everything about how uneven this slowdown actually is. It's not hitting every suburb the same way, and it's not hitting every price bracket the same way either.
It's worth sitting with the yield numbers too, because this is the part most people miss. Sydney's gross rental yield is sitting at just 3.1%, the lowest of any Australian capital city, according to OpenAgent's market data drawing on CoreLogic figures. With the cash rate at 4.1%, that means most investors holding Sydney property without a big deposit are running a cash flow loss every single month before the tax changes even apply. And yet, rents keep climbing. Sydney rents rose 5.9% over the past year, and SQM research shows the vacancy rate tightening from 1.3% a year ago to 1.1% now. So renters are getting squeezed harder even as investors who own the properties are pulling back. That's the contradiction sitting at the center of this story. Tenants are paying more than ever, landlords are making less than ever, and new investors are walking in the door less than ever.
So where is investor money actually going? Tax advisors are already seeing the shift. New builds are fully exempt from the negative gearing changes and keep access to the old capital gains discount. That's pushing investor demand toward off-the-plan apartments, knockdown rebuilds, and new construction on vacant land rather than older, established houses. There's also a holding pattern forming. Because the rules only bite on new purchases, plenty of existing investors are choosing to sit tight rather than sell and trigger a capital gains event under rules that get less generous after July 2027. Several market analysts, including Propertyology's Simon Presley, have noted this could actually tighten stock in desirable suburbs over time, even while overall investor activity in established housing slows down. Building costs are part of this too. Construction cost growth has eased from a peak of 23.2% back in 2022 down to 4.4% now, but it's still rising, not falling. That makes new supply harder to deliver and puts a floor under the value of existing homes, even in a market where investor demand for them is cooling. There is one bright spot in the supply pipeline, though it comes with a catch. New apartment approvals across Sydney are up 49.2% year-on-year, which sounds like exactly what a supply-starved city needs. The catch is timing. Apartments typically take 2 to 3 years to go from approval to completion, so almost nothing being approved today reaches the market before 2028 at the earliest. Meanwhile, the state's population is projected to grow from around 8.1 million people to over 10 million by 2041, with central and western Sydney absorbing the largest share. The pipeline simply cannot keep pace, which is exactly why existing established stock keeps a floor under it even as investor appetite for it weakens.
As of this month, June 2026, Sydney is genuinely a market of two speeds. The premium end and the established house market, the segment investors used to dominate, has gone flat to falling for 5 consecutive months in the top quartile. Auctions there are clearing at barely half their usual rate. At the same time, the western and southwestern corridors, sitting in the path of the new Western Sydney Airport opening in October and the $11 billion Sydney Metro rail line connecting St. Mary's to the new Aerotropolis, are still posting double-digit annual growth in some pockets. The M12 motorway has already opened toll-free, and combined public and private investment in the Aerotropolis precinct is sitting above $60 billion, between roughly $28 billion in committed government infrastructure and close to $33 billion in private development. The Sydenham to Bankstown line is also being converted into a modern metro through the second half of 2026, turning a century-old rail corridor into the kind of transport spine that tends to lift everything built around it. So this isn't a market collapsing everywhere. It's a market where the tax changes and the rate hikes have specifically hit the type of property and the type of buyer that built the last 20 years of Sydney investing, while a completely different part of the city, built around infrastructure rather than capital growth history, keeps moving in the opposite direction.
If you're a homeowner sitting in an established eastern suburbs or lower North Shore property, this slowdown mostly shows up as a quieter market. Fewer people walking through your open home, more time on market if you decide to sell, but no sign of a collapse, because that part of the city still has not enough housing for too many people who want to live there. If you're a renter, none of this is good news yet. Vacancy is tightening, not loosening, and investors pulling back from buying doesn't mean existing landlords are letting go of their properties. It just means fewer new rental properties are entering the system at a time when the city badly needs more of them. If you're a first home buyer, this is probably the most interesting moment you've had in years. You're now competing with fewer investors for established homes. You have a government-backed path to a 5% deposit, and clearance rates below 60% generally mean more room to negotiate rather than getting outbid at auction. And if you're an investor, the decision now genuinely depends on what you're buying and when. Established property bought after May 12th plays by a tougher set of tax rules. New builds, knockdown-rebuilds, and anything that adds genuine new housing supply still get the old treatment. That's not a small distinction anymore. It's the whole strategy. No one expected the rules to change this fast, or for clearance rates to fall this far in just a few months. For homeowners, renters, and investors, the message right now is the same. The ground under Sydney property just moved, and everyone is still figuring out where they're going to land. If you found this useful, subscribe for more breakdowns of what's actually happening in the property market, not just the headlines.